Joining us now from Chicago is Jim Bianco. He's the president of Bianco Research. And of course, Jim, if you take a look at the board, stocks down in the U.S. for a second day, what would you characterize as the leading catalyst for a lot of these losses?
Well, what's been happening with the U.S. market over the last several months, the last several days, has been all the talk about whether or not the Fed is going to do quantitative easing. When we get talk like Bernanke's speech at the NABE on Monday that it might happen, the market rallies. And then when we get some people trying to walk it back or rethinking it, the market seems to struggle. And that applies across the board for risk assets as well. Commodities are in the same boat as well. So I think what we've had is a little bit of a walk back after Monday's speech by Bernanke, where people were thinking quantitative easing was coming, and now after they've reflected on the speech, they're a little unsure that it might happen as early as June or July.
Now, Jim, would you even expect quantitative easing to happen going into an election year?
Yeah, I do. There's two questions with the Fed. What should the Fed do? What will the Fed do? I've never been a fan of quantitative easing, but I recognize that from the Fed's language and from what a lot of market participants have been saying, it's a reasonable bet that there's going to be something that happens after Operation Twist ends in June. The Fed is afraid that if they do nothing starting July 1st, that we could see a dramatic rise in interest rates and a sell-off in markets that would upset the economy. So we expect them to do something starting July 1st, and a lot of people are thinking quantitative easing.
And Jim, I know you're a commodities guy. Looking at gold right now, to the extent that quantitative easing does not happen, what can we see going into Q2 as of next week in terms of where gold is going to be at?
Gold is going to trade a lot more like the stock market and has been trading like the stock market. When there is quantitative easing, that heightens the chances of excess inflation and gold goes up. And when there isn't, it lessens those chances and gold goes down. So unfortunately, if you're buying gold because you're trying to get something to diversify away from financial assets like stocks, you're going to buy into something that's going to have a high degree of correlation with stocks. Now, saying that, I do suspect that gold and stocks will probably continue to tread water over the second quarter. I don't think we're going to see anything near the gains we had in the first quarter. Maybe 0, maybe -1 for the second quarter after a little bit of a rally in the first part of the quarter.
So more or less you mentioned stocks may tread water, but it's fascinating because if you take a look at global stocks, they've been having their best year in terms of their start since 1998. I believe the MSCI All-World Country Index is up some 11%. To what extent is that going to be impacted if you take a look at some of the analysis you just talked about?
Well, they're also, the U.S. stock market is doing something similar, and the U.S. stock market's got nearly a 40% weighting in the MSCI All-World Index as well. So if the U.S. stock market's going to start treading water, then 40% of that index is going to start treading water as well, too. And I suspect that you'll see dramatically less returns in the second quarter. Now, what could upset that would be as if we had inflation, which may happen, but maybe not as quickly as the second quarter, or if the Fed turned around and surprised everybody and emphatically said, no more quantitative easing. So I suspect world stocks will be somewhere around that 0 to -1 rate for the whole quarter after a decent rally in the first half of the quarter.
Jim, I'm going to come back to you to see if you are right. Thank you so much. We have Jim Bianco, the president of Bianco Research, right there.